welcome back to my channel. My name is Ellie Cooper. This channel is all about helping you find financial clarity and align your financial goals with your personal goals. So today we have a really important topic and one that could save you thousands of pounds, and that is how to pay yourself as a director of a small company. So whether you're an agency owner or a small business that sells products, how you pay yourself is going to impact your tax bill at the end of the year. Both your corporation tax bill and your self-assessment tax bill. So I work with many small business owners, and some of them are not taking out the money that they hope to take out of the business. They are taking out less than what they could take out, and they're not aware that they can take out more, or they're taking out a good amount of money, but they are overpaying in their taxes. And there's a couple of things we can do to solve all of those issues. Obviously, it's important to pay the taxes that you need to pay. Popping in here, so actually I was just editing this piece about the tax, and I wanted to just share an encouragement that I try and share with a lot of my clients, which is around a lot of people have this idea of tax being like super evil, and we want to pay as little tax as possible. And in one way, yeah, that's true. We don't want to be overpaying tax for no reason. We don't want massive tax bills that we're unaware of popping up. We want to obviously maximize our take-home pay. But on the other hand, it's important to remember that the more tax you pay, it means you're taking more money home. It means your business is doing better. And so I encourage you to try and shift your mindset around taxes if you do have a negative mindset around them, to be more appreciative of having a higher tax bill, as strange as that may sound, because it's an indication of a good work done. It's an indication that you are taking home more money. The way this tax system works in the UK is you cannot make more money and take home less money. So any extra money you make, you're paying more tax on, potentially, if you're getting into different tax brackets, but it will never eat away at the money that you've already been taking home. So if you jump up to that next tax bracket, like I'll explain later in this video, to let's say 70k from 50k, yes, your tax bill is going to be much higher, but you're still going to be taking home a lot more money than you were when you were taking home 50k. So the main thing we want to do is not eliminate the need to pay tax, but to optimize it and to make sure you're aware of the tax bill. And then you can put money aside and your tax bill comes and you're like, yeah, I had a good year. I made a lot of money. That's our goal here. Nothing in this video is about not paying the taxes that you should be paying. It's about making sure that you're optimizing your taxes in the right way. One of the first things that's important to remember is that your income is taxed from around the world. So if you have a rental property in the States, or you receive dividends from a German company, that also needs to be included in your income tax, and it will potentially affect how much tax you're paying in the UK as well, even if you have paid tax on those amounts outside of the UK. It doesn't mean that you'll get taxed twice on those amounts, but it will come into your calculation that we'll see in a second. So the way the HMRC calculates your taxes is based off of this outline. So you're going to start with your PAYE salary. That's the first thing that they look at, and that's where 9 times out of 10 your personal allowance is going to be accounted to. Your personal allowance is an amount of money that you can take out or that you can receive tax-free. Everyone has one. Yours might look slightly different if you earn above a certain amount, or for whatever reason you're paying back taxes from previous years. 9 times out of 10 you're going to have this personal tax code, which means you can take out £12,570 every single year. A good thing to remember here is your basic pay rate is up to £50,270 at the moment. That means that any money up until that bracket is charged at 8.75% dividends tax. Why that's an important number is because after this, it increases to above 33% tax. So obviously it doesn't mean don't pay yourself above the 50,000 mark, but it does mean be aware that any money you pay yourself above the £50,000 mark does give you a much higher tax bill at the end of the year. There's a couple of things you can think about when taking money out of the company that's going to be above the 50 grand mark. And some of it has to do with your personal situation, how much money you're looking to take home, what your business does, what expenses can be put through the business. But one interesting tax optimization strategy is to pay for your pension through your limited company. So as a director of a UK limited company, you can pay up to £60,000 a year into a pension. This can be a full expense to your company, so again, reducing your corporation tax bill, and it's also tax-free at the moment for you. Obviously, the pension is in a specific investment fund, which you can't take out until the specific date, depending on what pension you have and depending on the state age at the time. But it's something to think about if you have excess cash in your company. Now, if you're a business owner that is already receiving salary from another company, either your business is your side hustle or for whatever reason one of your clients are paying you through payroll, then do not take any payroll out of your company. You should only be on one payroll across the board for tax optimization. So if that's you, then don't follow what I'm about to say. So the director's optimal salary for the 2024-2025 year and the 2025-2026 year is £12,570. So exactly the same as the personal allowance. Paying yourself the £12,570 salary does incur an employer's NI of £478. If you are eligible for the employment allowance, then this is reduced to nil. Broadly speaking, you can claim the employment allowance if you have more than 2 employees, but you pay less than £100,000 in national insurance each year. If you are not eligible for the employment allowance, it might be more beneficial to pay yourself the £9,100 salary, which is the secondary threshold, meaning there's no national insurance to pay. This is a good thing to check with your accountant, but in the end, you were talking a couple of £100 across the year difference. So you might be wondering why not pay yourself a higher salary and not the dividends, and that's purely down to tax rates. So once you get above the personal allowance and the primary and secondary threshold, you start paying income tax and national insurance tax through payroll. Those two combined are higher than the dividends tax rates. What's important to also remember is if you do pay yourself the £12,570 instead of the £9,100, that year does count towards your national insurance contributions, even though you technically as an employee didn't pay any national insurance, your employer did, which is still your company. Whereas if you pay yourself £9,100 or below, then it doesn't count towards your national insurance year, and so you might want to voluntarily contribute. The rest of your money you can then take out as a dividends. So what this looks like could either be a monthly dividend that you take out a set amount, it can be a quarterly set amount, or it can be an ad hoc amount. A couple of things that you need to remember when you're taking out dividends. First thing is, by the book, you should be submitting dividends vouchers to Companies House. That's where you say, this is the amount of dividends that I'm taking out, and this is a date that it was released, and these are what the shareholders are getting. If you're the sole shareholder of your business, then whatever you pay out is just yours. If you have someone who has a shareholding in your company, either that could be a co-founder, it could be an investor, they are potentially entitled to the amount of dividends that you release in that specific period of time. So please remember that and make sure you double check with your investors, with your co-founders, what your agreements are when it comes to dividends. Assuming you're free to take the dividends that you want, then you can take the rest of your money as dividends. A couple of mistakes that I see quite often with business owners who are coming to me to do their accounting is they've taken too much dividends. In England, if you own a limited company, you're only allowed to take your net profit minus your corporation tax out of the company. That does not always and likely never will equal what's in your bank account. So it's really important to work with an accountant to make sure you're really clear about what your net profit after tax is going to look like. To be safe, what I usually suggest to my clients is that they take a specific amount each month, which is 100% within the net profit minus tax. And then once or twice a year, you can take a higher amount as a bonus, depending on the performance of the company. If you overdraw your dividends, there's a couple of other taxes that are applicable. So number one, you get a benefit in kind tax. That is a tax based off of the benefit of loaning money from your company without interest. It's usually a relatively small amount, but it is an extra amount that both you and the company need to pay. Number two is a type of corporation tax, which is temporary, but you have to pay 33.75% of the total loan at that moment to the government until you pay it back. Also keep in mind, when you pay it back, eventually you can apply to receive the tax back, but it can take months up to a year to actually get that tax back into your business account. So for cash flow purposes is not ideal at all and should only be done if absolutely necessary. One really important thing to keep in mind is the state pension contributions. So in England, you need to pay into your national insurance at least 10 years and maximum of 35 years to get the full state pension. So keep that in mind when you're thinking about your tax planning. Dividends you do not need to pay national insurance into, so you may want to opt in to pay national insurance if you're not paying national insurance through another income source. That way you know that you're contributing towards your pension for the future. Although do keep in mind that the national state pension is currently 1/4 of the national living wage, so it's a very low amount. If your national insurance bill is going to be very high, it could be worth investing that money instead. If you're paying for health insurance or life insurance, you could be paying for that through your company too. These things often incur a benefit in kind tax, but it could still be worth it based off of the corporation tax that you save and having that as a benefit for all of your directors and future directors if that's something that you want to do through your company. Also remember, a nice way to decrease your corporation tax liability is to give a few more benefits to your staff. Whether that's health insurance, whether that's a cycle to work scheme, whether that's contributing a little bit more into their pension, all of these are full expenses to the company and will reduce your corporation tax liability. Again, we're coming into this balance, so we need to balance what you are expensing and therefore what your net profit minus corporation tax looks like, and what you would like to take home with dividends, and then what your income tax will look like. So I'm going to go through a couple of examples of different levels of dividends that you might pay yourself and what the tax consequence would be on that. Please double check this with an accountant as well, because there are various things that could impact how much money you have to pay in tax. So the first scenario, you're paying yourself £12,570 in salary and £40,000 in dividends. This would incur a tax bill of £4,032 across the year. The second scenario, again, you're paying yourself £12,570 salary and then £50,000 in dividends. This would create a tax liability of £7,406. So this is a great example of someone who has just gone over the threshold because now they're paying themselves
£62,000 when the threshold is £50,000, and you can see that significant increase in tax. So our third and final scenario, you're paying yourself £12,570 salary and £100,000 dividends. This is going to create a tax liability of £25,853. Thank you for watching my YouTube video. If you liked it, please hit like and subscribe to my channel. I'll be posting videos just like this about small business finance, tax optimization, and ultimately finding your financial clarity. Thanks again.